How much does the growth rate you earn in retirement affect your Roth conversion strategy? Will growing wealth at 8% instead of 6% drastically change how much you should be converting today? We're going to examine this question in today's video. Now, starting off this conversation, I think it's important to review the most common reason a retiree should consider Roth conversions. And that reason is required minimum distributions, or RMDs. RMDs are a forced distribution from your tax-deferred accounts once you reach age 73 or 75. You have no choice over this distribution. It's mainly these distributions that force retirees into major tax issues. As you can see on the screen, when this retiree has control in their withdrawal strategy and no forced distribution, taxes are quite low. Once RMDs begin, taxes steadily rise to uncomfortable levels. RMDs can push you into higher brackets. They can push you into tax hurdles like the Social Security tax torpedo or force you into owing more for Medicare. RMDs are the main culprit of higher taxes in retirement, and Roth conversions can help avoid and minimize those RMDs. I bring this up because portfolio return can greatly affect the size of your RMDs. When you look at many forward-looking tax graphs, like the one I just showed, you will notice that RMD problems generally continue to grow over time. This is because of how the RMD formula is designed. The RMD you are mandated to take each year is based off your age. The older you are, the higher the withdrawal rate will be. Starting off at 73, the rate will be about 3.77% and rise to just over 4% by 75. This rate does not increase linearly, but rather exponentially, whereas if you are lucky enough to live into your 90s, you will be forced to take more than 8% per year from your IRAs. So not only does that withdrawal rate increase, but because of a lower starting withdrawal rate, you often see your portfolio grow through those RMDs early on. You will be forced to withdraw from these accounts, but not yet draw down these accounts. With any reasonable growth rate, this will mean your accounts will generally grow often until you reach your mid-80s to late 80s. So we have two underlying mechanisms here that cause those RMDs and therefore your tax liability to steadily drift higher and higher. On the flip side, if a portfolio struggles, either due to poor decision making or a bad economic environment, RMDs can naturally be minimized to an extent. But again, how much will a higher or lower portfolio return change your overall Roth conversion strategy? Within this question, I think it's important to review just how wide the dispersion of returns can be in investing. On the screen, I have a snapshot of rolling stock returns based on different time horizons since 1871. If we focus on the longer periods like 20 and 30-year rolling returns, even with longer time horizons, we can see quite a bit of dispersion in returns. Returns can be as low as the single digits or as high as the mid to high teens. Even if we look at a more balanced portfolio, one that would be closer to how a retiree might invest, we see this dispersion will tighten, but still be fairly wide. Given this, in our broad tax analysis, it's important to look at multiple scenarios. Too often I see retirees or advisors run just one analysis, say using average historical returns, and they might find that maxing the 22% bracket is the best strategy. Okay, but what if we increase or decrease returns by 1 or 2%? Would this greatly change your optimal strategy? If so, we should be cautious moving forward with that Roth conversion strategy. The last thing we want to do is go too aggressive and end up with our Roth conversion strategy actually hurting our retirement. Go too aggressive and you'll actually end up paying more in taxes. Here at Safeguard, we generally run a median or expected trial for clients, but then also look at a 25th and 70th percentile trial as well. If the optimal strategy is the same in all three trials, then great, things are pretty straightforward. But if strategies vary widely in each trial, this tells us we need to have a deeper conversation with that retiree and talk through the benefits and drawbacks of each approach. We need to dive into the context here. Well, let's go through a case study and see if we can see a real-world example on what effect portfolio return can actually have. Here's the example we will walk through. We are using a 62-year-old couple here, Sally and John. They have $2 million in retirement assets. $1.5 million is in tax-deferred accounts. So when 75% of one's assets are subject to RMDs, we have some issues that we can probably fix with some Roth conversions. Their goal spending in retirement is $100,000 per year, which they can conservatively meet in their situation. For the sake of simplicity, we're going to have them invest in a 60-40 portfolio. Okay, so let's look at their tax situation in a normal environment. We define normal in this context as historical averages. Historically speaking, a 60-40 portfolio has averaged more than 8% per year, which offers some sizable growth even after inflation. Now, the benchmark withdrawal process that we're going to be comparing to is basically the traditional method of exhausting your taxable account first, tax-deferred accounts second, and then tax-free accounts last. Without Roth conversions factored in, this is generally optimal in most cases because your taxable account is thought of as a leaky bucket that causes you to owe taxes annually on dividends, interest, and more. Given this method, we can see the classic cascading tax graph where taxes are extremely low early on, and then once RMDs begin, everything starts to spiral. The longer they live, the worse this situation becomes. And this isn't even factoring in the widow trap, where one spouse survives the other for a period of time and thus has half as much room in each tax bracket. Here's a look at the top marginal tax bracket this couple would be subject to. As soon as RMDs begin, they are pushed into what will be the 25% bracket, and then for the last decade or so of their life, they spend quite a bit of time in the 28% bracket. Now, keep in mind, there's a lot of hidden layers to consider here. If this couple is seeing the 28% bracket, they're also going to be penalized and owe higher Medicare costs. They're also going to see their Social Security benefits fully taxed. They will likely recreate a taxable account after exhausting it because they won't need their full RMD and generally will pay taxes on that RMD and then reinvest the rest in a taxable account. So let's take a look at just how large we expect RMDs to be at each given age given this analysis. This is all in today's dollars, by the way. Immediately, their first RMD is just over 6 figures and increases by about $30,000 plus with each 5-year increment. If they live to age 90, their RMD would be over $200,000 in today's dollars. Again, this is just based on average historical returns. And so if we run this couple's situation through our tax software here at Safeguard, we will find the optimal Roth conversion strategy that they could implement is to max out the 22% bracket until their IRA balances are down around $500,000. The second best strategy is a strategy labeled as the Tax Cuts and Jobs Act optimized strategy, which involves converting at 24% for the next 2 years and then 25% thereafter. These strategies are close, but the more conservative strategy wins by a slight margin. Now, this graph shows Roth conversion value a bit different than other summary charts you might see. The y-axis shows the after-tax value from a Roth conversion strategy, and the x-axis shows the amount of time spent in retirement. If this couple lives into their 90s, we can see that they will have more than $1 million in after-tax value. But the reason I like to use this graph is it shows deeper context than just one longevity period. We can look at their tax benefit if they would pass away at instead, let's say age 85. Here we'd see closer to about $500,000 in after-tax value. Okay, so everything might make sense up to this point, at least I hope. But what if we vary returns this couple experiences? We've discussed historical averages. What if we increase historical averages or decrease historical averages by 1%? Well, here's what would happen to the RMDs at the 4 age bands. Because higher returns compound, we see that earning 1% better returns makes it where you see a similar RMD to the historical benchmark, but often see that sized RMD about 5 years sooner. The age 90 RMD would be over $250,000 in today's dollars. On the flip side, earning a smaller return has the opposite effect. Here, the age 90 RMD only, and I say only a bit tongue-in-cheek, grows to only $147,000. Yes, still large, but about $100,000 less than having a growth rate 2% higher on average. So we clearly see that portfolio return has an effect. This shouldn't be surprising. But what does it mean for that conversion strategy? Well, if we band returns into 2% increments, we can see how the optimal strategy changes. And the one thing that is noticeable, at least in this specific situation, is the best strategy doesn't change as much as one would think. If 8.5% return is close to our benchmark historical average, then we would need to see a return less than 6.5% for the optimal strategy to change. Technically, if I broke this into 1% increments, we would need to see a return less than 5.5%. A whole 3% decrease in average return for the best strategy to be maxing out the 12% bracket instead of 22%. On the flip side, it would take a return of about 3% higher or 11.5% to see a more aggressive strategy make more sense. At this point, the best strategy becomes the Tax Cuts and Jobs Act optimized strategy that I noted earlier. Now, 11.5% or 12.5% would be an incredible return for a 60-40 retirement throughout your retirement. But even at this point, we don't see crazy aggressive strategies like convert everything in 1 year win out. And as a PSA, large conversions where you're converting all at once or moving into higher brackets like the 35% bracket almost never makes sense. Now, this analysis might be surprising to some. Yes, we see a portfolio return has an effect, but we would need to see a wide distribution in returns to see differing optimal strategies. Now, let's go ahead and examine the reason why. Here's the marginal bracket comparison between the benchmark withdrawal method and maxing the 22% bracket. The first thing we'll see is why this strategy makes sense. Comparing rates to rates, you convert at 22% and 25% to avoid being taxed at 25 and 28%. But this graph clues us into why higher portfolio growth doesn't greatly affect our strategy here. If I highlight the conversion years here, we effectively see 5-ish years needed to bring us down from a $1.5 million balance down to around a $500,000 balance. Right now, a married couple can show over $230,000 worth of income and still see themselves in the 22% bracket. And so if we jack up returns from 8.5% up to 10.5%, yes, they might need to convert for 6 or 7 years, but in this couple's situation, they have the time. Now, if they were 70, this would all be a different story because RMDs would be right around the corner. And so although portfolio returns matter, there are other variables that matter at an equal weighting, like total time to convert. This couple retired and planned early enough that they have time. But this entire discussion is very contextual. I don't want you to take from this video that portfolio return doesn't matter that much. It's all dependent on the situation. Let's say that we have an older single filer with more tax-deferred assets and less time to convert. Portfolio growth will matter much more for this person because they are less able to quickly fix RMD issues with conversions. They have less room in each tax bracket because of being a single filer, and they have larger tax-deferred balances. This means that although they might be converting, the growth within their IRA may dwarf that conversion. For instance, if they convert $150,000 but their IRAs grow $250,000, they're constantly playing catch up and will never draw down their IRAs with conversions. There are two other things to think about here. One of the biggest things that varying portfolio returns will do is change the benefit of any conversion strategy. For instance, thus far we've shown about $1 million of after-tax wealth improvement if this couple lives into their 90s based on historical rates. Let's look at a break-even tax graph of all methods if the portfolio only earned 4.5%. Here, we see the 12% bracket strategy went out slightly, but the maximum wealth improvement here is about $300,000, about a third of the benefit we see at higher portfolio returns. The other thing to keep in mind is the risk in converting aggressively if returns are worse than expected. Say the couple went aggressive right off the bat and started converting into the 24% bracket and then into the 28% bracket, expecting higher portfolio returns. Then, to their disappointment, portfolio returns weren't as great and only averaged 4.5%. For the majority of their retirement, this couple would be underwater with their conversion strategy, costing about $100,000 in after-tax wealth at the worst point. And so this is where context really matters in this entire discussion. Portfolio return may have a small effect on your conversion plan, or it may be something that largely controls your plan. Ultimately, you should be working with someone capable of talking through this context with you. Tax planning is not a process that is determined once, and then you unwaveringly follow that strategy. This is a dynamic process. Planning here is more important than a plan. I hope you found this video informative. If you're wanting to learn more about how to nail down the right Roth conversion strategy for your situation, click on this video right here where we fix 10 Roth conversion misconceptions that are all too common. Click here to learn more, and always remember, you don't need more money, you need a better plan. We look forward to seeing you in the next video.